This content reflects my personal observations and learning process while studying financial markets and digital assets. Any discussion of trading strategies or market structure relates only to my own trading framework and personal trading system. This material is for informational and documentation purposes only and should not be interpreted as financial advice or a recommendation to buy or sell any security or digital asset. Episode 12, Staying Operational in an Increasingly Automated Market. During my recent reading about developments in the digital asset space, I came across a discussion about how artificial intelligence may eventually participate more actively in financial systems. Some technology leaders believe that in the future, automated systems could execute large numbers of financial transactions as part of completing digital tasks. Whether or not that prediction unfolds exactly as described is still uncertain, but the idea itself highlights something that has already been happening in financial markets for many years. Markets have gradually become more automated. Algorithmic trading systems, quantitative strategies, and high-frequency trading platforms already participate heavily in modern markets. In many cases, machines are already responsible for a large share of daily transactions. From a retail trader's perspective, this raises an important question. If markets continue becoming faster and more automated, how should an individual trader think about operating within that environment? For me, the answer goes back to the structure of the trading system itself. My approach has never depended on predicting every short-term movement in the market. Instead, the focus is on building a framework that remains operational regardless of the market environment. Markets may be driven by human emotion, algorithmic trading systems, or eventually even more sophisticated automated agents. But the core principles of a disciplined trading approach do not change. First, capital exposure must remain controlled. Maintaining a strong cash reserve ensures that the system can absorb market volatility without forcing reactive decisions. Second, entries must remain structured. Positions are opened based on defined criteria rather than reacting to rapid price movements. In an environment where automation can create sudden fluctuations, patience becomes even more valuable. Third, the system must remain focused on survivability rather than constant activity. Not every market movement requires participation. Sometimes the most important decision is simply waiting until the market presents a situation that fits within the system structure. If financial markets continue evolving toward greater automation, one possible outcome is that price movements become faster and sometimes more volatile. But increased volatility can also create opportunities, particularly for strategies designed to generate income through options and structured positions. In that sense, the presence of more automated participants does not necessarily invalidate a disciplined retail trading system. In many ways, it simply reinforces the importance of having one. Technology will continue to evolve. Markets will continue to change. But the goal of a well-designed trading system is to remain functional across those changes. The objective is not to predict every new technological trend. The objective is to maintain a framework that allows the trader to remain operational regardless of who or what is participating in the market. Because in the end, successful trading is not about reacting to every new development. It is about maintaining discipline, protecting capital, and operating with a system that can survive across different market environments. And as always, the same principle continues to guide my approach. Before capital moves, understanding must come first. and in every market, knowledge should come before allocation.